If you were born before 1961, there is a letter sitting in a mailroom right now with your name on it. And what it says could change how much money lands in your bank account every single month for the rest of your life. Maybe you already opened it and you are confused. Maybe it has not arrived yet and you are wondering what everyone online is talking about. Either way, stay with me for the next few minutes because I am going to walk you through exactly what changed, why it changed, what it means for your specific birth year, and what you need to do before this affects your check. Are you ready to find out if you are one of the millions of Americans directly impacted? Let's get into it. Before we go any further, if you find this information useful, do me a favor and hit that subscribe button and tap the notification bell. I put out videos like this every single week covering Social Security, Medicare, and retirement changes that mainstream news barely touches on. And the algorithm only shows this to more people like you if you engage right now. So take 2 seconds, subscribe, drop a like on this video, and let's break down what is actually happening. Let's start with the most important question. If you were born in 1960 or earlier, you are now on the other side of a rule that has been slowly phasing in for more than 4 decades. Here is what I mean. Back in 1983, Congress passed amendments to Social Security that gradually pushed the full retirement age, which people often call FRA, up from 65 to 67. That change did not happen all at once. It rolled out slowly, 2 months at a time, birth year by birth year, so that nobody could really point to one single moment and say, that's the day everything changed. But 2026 is different because this is the year the phase-in finally completes. If you were born in 1960, your full retirement age is now locked in at 67. If you were born in 1959, your full retirement age landed at 66 years and 10 months. And if you were born in 1958 or earlier, you already crossed your full retirement age threshold in previous years under the older, slightly lower numbers. So why does this matter to you right now in the middle of 2026 if this has been coming since the Reagan administration? Because this is the year the Social Security Administration is sending out updated benefit statements and notices reflecting the fully phased-in rules, along with a set of other changes that took effect on January 1st of this year. And if you are someone who has not yet filed for benefits, or you are thinking about when to file, or you are already collecting and wondering whether your check is calculated correctly, this is the moment those pieces come together. Have you checked your own full retirement age lately? Do you actually know down to the monthly when you qualify for 100% of your benefit? If not, stick around because we are going to make that crystal clear. Let me lay out what actually shifted this year because there is a lot of noise out there and I want to give you the real verifiable picture rather than vague scare talk. There are 6 major changes that took effect for 2026 and each one interacts with your birth year in a slightly different way. The first change is the cost of living adjustment, commonly called COLA. For 2026, benefits increased by 2.8%. That might not sound like a headline-grabbing number, but let's put it in real terms. The average retired worker saw their monthly check go up by roughly $56. Over a full year, that adds up to a few hundred extra dollars in your pocket. Now, is 2.8% enough to keep pace with what you are actually spending on groceries, gas, and utilities? That is a fair question, and it is one worth asking your own household budget rather than taking anyone's word for it. The COLA is calculated using something called the Consumer Price Index for urban wage earners and clerical workers, or CPI-W for short, and it compares prices in the third quarter of one year to the third quarter of the previous year. If prices went up, your check goes up. If prices went down, and this has genuinely only happened 3 times since 1975, your check simply stays the same. It never decreases because of COLA math. The second change, and this is the one most directly tied to the born before 1961 story, is the full retirement age itself finishing its climb to 67. For decades, Americans grew up believing 65 was the magic retirement number. That number has not been accurate for a very long time, and as of this year, it is fully replaced. If you are 66 today, are you sure you know whether you have reached your own full retirement age or not? Because getting this wrong by even a few months can mean permanently accepting a smaller check for the rest of your life. The third change involves how much you are allowed to earn while still collecting benefits if you have not yet reached full retirement age. In 2026, if you are under your full retirement age for the entire year, you can earn up to $24,480 before the Social Security Administration starts withholding money from your check, specifically $1 for every $2 you earn above that limit. But here's a detail a lot of people miss. In the year you actually reach full retirement age, that limit jumps dramatically higher to $65,160, and the withholding rate becomes more forgiving too, at $1 withheld for every $3 earned above the limit. And once you cross into full retirement age, this earnings test disappears entirely. You can earn as much as you want with zero reduction. Did you know that distinction existed? Because I talk to people all the time who quietly reduce their work hours out of fear of losing benefits, when in reality, money withheld under this test is not lost. It is repaid to you later through a higher monthly benefit once you hit full retirement age. The fourth change is on the tax side. The maximum amount of your earnings subject to Social Security tax jumped to $184,500 for 2026, up from $176,100 the year before. If you are still working, this means a bit more of your income gets taxed for Social Security this year, which, yes, might sting a little on your pay stub, but it also feeds directly into the system that funds the checks going out to today's retirees, including possibly you or your parents. The fifth change involves Medicare, and this one deserves special attention because it directly eats into that COLA increase we just talked about. The standard Medicare Part B premium rose from $185 a month in 2025 to just under $202 a month in 2026. For most beneficiaries, this premium is automatically deducted straight from your Social Security check before it ever reaches your bank account. So when people say my COLA increase disappeared, this is very often exactly why. Do the math with me for a second. If your COLA added around $56 a month and your Medicare premium went up by roughly $17 a month, your net gain is smaller than the headline number suggested. Has this happened to you? Have you looked closely at your deposit and wondered where the increase actually went? The sixth change relates to required minimum distributions from retirement accounts like traditional IRAs, which under the Secure 2.0 Act now begin at age 73 rather than 72. While this is not technically a Social Security rule, it interacts closely with how much of your Social Security benefit ends up being taxable, because the income thresholds that determine whether your benefits are taxed have not been adjusted for inflation since the 1980s and 1990s. That means more and more retirees year after year find themselves crossing into taxable territory simply because everything else around them got more expensive, while those thresholds stayed frozen in time. Now let's talk about that letter, because that is what brought a lot of you here. Every year, the Social Security Administration sends out notices to beneficiaries explaining their new benefit amount for the coming year, reflecting the COLA increase, any changes to Medicare premium deductions, and for people near the full retirement age threshold, confirmation of exactly when their own personal full retirement age falls. This is not some secret internal memo. It is a standard expected piece of mail that goes to tens of millions of people. But the timing and content this year happens to line up with the completion of that 4-decade-long age phase-in, which is exactly why so many people are searching for answers right now. If your letter has already arrived, have you actually read the whole thing, or did you skim it and set it aside? Because buried in the details of that notice could be information that changes how you plan the next 5, 10, or 20 years of your retirement income. If your letter has not arrived yet, here is something worth doing today rather than waiting. Create or log into your personal My Social Security account directly on the official SSA.gov website. Inside that account, you can see your estimated benefits at different claiming ages, your exact full retirement age down to the month, your earnings history, and any notices the agency has sent you. Waiting for paper mail in 2026 means waiting for information that is already sitting there online, ready for you to check right now today before you finish watching this video. Let's zoom out for a second and talk about why this particular birth year cutoff carries so much emotional weight for people. If you were born before 1961, you likely grew up with parents or grandparents who retired at 65 and never had to think twice about it. That was simply how it worked. You may have built your entire mental retirement plan around that number without realizing until recently that the rules shifted underneath you gradually year by year while you were busy working, raising a family, and building a life. Does that feel familiar? Does it feel a little unsettling to realize a number you assumed was fixed was actually a moving target the whole time? This is exactly why understanding your own full retirement age matters so much right now. Claiming benefits even 1 year before your full retirement age results in a permanent reduction of your monthly check. And I want to stress the word permanent because it does not correct itself later. If your full retirement age is 67 and you claim at 62, the earliest possible age, your benefit is reduced by up to 30%. And it says reduced for as long as you live. On the flip side, if you delay claiming past your full retirement age, your benefit grows by roughly 8% for every year you wait all the way up until age 70. After 70, there is no additional benefit to waiting further, so that is generally considered the practical ceiling. Think about what that actually means in dollar terms. If your full retirement age benefit would have been $2,000 a month, claiming at 62 might bring you down to around $1,400 a month. Waiting until 70 could push that same benefit up toward $2,480 a month. That is more than $1,000 swing every single month for the rest of your life based purely on timing. Have you ever sat down and actually calculated what claiming early versus claiming late would mean for your household? Most people have not, and that is not a criticism. It is simply because this information is scattered, confusing, and not explained clearly by the agencies that should be explaining it. Here is something else worth knowing if you are married, widowed, or divorced. Spousal benefits, which can be worth up to 50% of your spouse's full retirement age benefit, are also affected by these same age rules. If you claim spousal benefits before your own full retirement retirement age, that amount gets reduced too. And if you are divorced, as long as your marriage lasted at least 10 years and you have not remarried, you may still be entitled to benefits based on your ex-spouse's earnings record. And here is the detail that surprises people the most. Your ex-spouse does not even need to have filed for their own benefits yet, and they are never notified that you have claimed against their record. Did you know that option existed? How many people do you think are leaving that money on the table simply because nobody ever told them it was available? For widows and widowers, the rules shift again. A surviving spouse can receive up to 100% of the deceased spouse's benefit, and that eligibility can start as early as age 60 or age 50 if the surviving spouse is disabled, and if the spouse who passed away had delayed their own claiming until after their full retirement age, building up that higher delayed benefit, the surviving spouse inherits that larger amount rather than a smaller one. This is one of the most overlooked reasons that delaying benefits when financially possible can be such a powerful decision for married couples, because it is not just about one person's check. It is about protecting whichever spouse lives longer. Now, I want to address something directly because I think honesty matters more than clicks. You have probably seen other videos online with dramatic titles claiming Social Security is about to disappear entirely, or that benefits are being secretly cut for people over 65, or that some shadowy new law is stripping seniors of their checks. I am not going to tell you that because it simply is not accurate. What is true, and what the Social Security Board of Trustees has publicly reported, is that the combined trust funds are projected to become depleted around 2033 if Congress takes no further action. That does not mean checks stop being paid. It means that based on current projections, incoming payroll tax revenue alone would only be sufficient to cover a little over 3/4 of scheduled benefits from that point forward, unless lawmakers act before then, which historically, going back to the 1983 reforms we talked about earlier, is exactly what Congress has done when previous shortfalls approached. Is that a real serious issue worth watching? Absolutely. Is it the same thing as your check is being eliminated next year? No. And you deserve accurate information rather than fear designed purely to keep you watching. So let's turn this into something practical. What should you, sitting there right now, born before 1961, actually do with this information? First, log into your My Social Security account on the official government website and confirm your exact full retirement age and your estimated benefit at different claiming ages, including 62, your full retirement age, and 70. Seeing the real numbers side by side, specific to your own earnings history, is far more useful than any general chart, including the ones I have described in this video. Second, if you are still working and under your full retirement age, take a hard look at the earnings limits we discussed. $24,480 if you are under full retirement age all year, or $65,160 in the calendar year you reach it. Understand that money withheld under this test is not gone forever. It is factored back into a higher benefit later, which changes how you might think about part-time work in these transition years. Third, if you are married, sit down with your spouse and actually run the numbers on spousal and survivor benefits together rather than each of you assuming your own individual claiming strategy is the whole picture. The decision of who claims when can meaningfully affect what the surviving spouse receives decades down the road. Fourth, pay attention to your Medicare Part B premium and how it interacts with your COLA increase. If you are on a fixed income, understanding that roughly $17 of your monthly COLA increase this year may already be absorbed by the premium hike helps you budget more accurately rather than being surprised when your direct deposit deposit is not quite what you expected. Fifth, and this is the simplest step of all, actually open and read your Social Security notices when they arrive, whether by mail or through your online account. I know it is tempting to set official-looking government mail aside for later, but these letters contain personalized numbers specific to your situation and later often turns into never. Here is the bottom line. If you were born before 1961, you are living through the final completion of a retirement age shift that has been rolling out slowly since 1983, layered on top of this year's cost of living adjustment, updated earnings limits, a higher Medicare premium, and tax threshold changes that have not moved with inflation in decades. None of this is a secret conspiracy, and none of it means your benefits are disappearing. But it absolutely does mean the numbers you may have grown up assuming, like retiring at 65 with no penalty, no longer reflect reality. And the difference between understanding these rules and ignoring them can mean a difference of hundreds of dollars every single month for the rest of your life. So here is my question for you before you go. Have you checked your own full retirement age yet? Do you know what your benefit would look like at 62, at your full retirement age, and at 70? If you are not sure, that is completely okay. But make today the day you find out, using your own My Social Security account rather than relying on someone else's general numbers, including mine. If this video helped clear things up for you, do me one more favor. Hit that like button so more people searching for real answers instead of fear-driven headlines can find this video. Subscribe if you have not already, because I break down changes like this every single week as new rules and notices come out. And drop a comment below telling me your birth year and whether your letter has arrived yet. I read every single one, and it helps me know exactly what to cover next. Thanks for watching, and I will see you in the next video.